Hello traders, welcome back. Having learned what the forex market is, how big it is, the different types of currencies and how they are sold in pairs, we need to ask ourselves, how do we trade forex? How does forex trading happen? Well, let's see how traders participate in forex trading. There are different ways to invest, rather speculate in currencies, including but not limited to 1. Retail forex, spot forex, currency futures, currency options, currency exchange traded funds, ETFs, forex CDFs, forex CFDs, and forex spread betting. In this case, we will cover different ways that individuals like you and I or retail traders can trade forex. Going to currency futures, these are the contracts to buy or sell a certain asset at a specific price on a future date. A currency future is a contract that details the price at which a currency could be bought or sold and set a specific date for exchange. Since futures are standardized and traded on a centralized exchange, the market is very transparent and well regulated, meaning the price and the transaction information are readily available. Currency EFTs. These ones offer exposure to a single currency or a basket of currencies. They allow ordinary individuals to gain exposure to the forex market through managed fund without the burden of placing individual rates. Spots FX. It is an off-exchange market or rather an over-the-counter market. Here the customer trades directly with the counterparty. Retail FX is a secondary over-the-counter market that provides a way for retail or rather in quote poorer traders to participate in the market. They make this possible by forex trading providers or forex trading brokers. They trade in the primary over the counter on your behalf by finding the best prices, and then they earn a markup before displaying the prices on their trading platforms. They allow you to control a large amount of currency for a very small amount. This concept is called leveraging. You can look it up. Then there's Forex spread bet. This one will allow you to speculate on the future price direction of a currency pair. A currency's pair price being used on the spread bet is derived from the currency's pair's price on the spot FX market. Your profit or loss is dictated by how far the market moves in your favor before you cross your position and how much money you have bet per point of the price movement. Spread betting on the forex is provided by spread betting providers. Forex CDF, Forex CFDs or the contract for difference. This one is a financial derivative where derivative products track the market price of an underlying asset so that traders can speculate on whether the price will rise or fall. A CFD is a contract, typically between a CFD provider and a trader, where one party agrees to pay the other the difference in the value of a security between the opening and the closing of the trade. Forex CDF is an agreement, or rather a contract, to exchange the difference in the price of a currency pair from when you open your position versus when you close that position. In conclusion, there are many ways to trade Forex, each with its own advantages and considerations. Whether you choose currency futures, options, ETFs, spot FX, or CDF, remember to trade responsibly and manage your risks. Thanks for watching. Don't forget to subscribe for more Forex trading tips and tutorials.